Scalping is a trading strategy that aims to profit from small price changes. It involves making numerous trades within a single day. The goal is to capture tiny gains that add up over time. Scalpers open and close positions quickly, often within minutes. This approach requires focus and discipline. Scalping is popular among day traders. It allows them to take advantage of market volatility. Scalpers don't wait for big moves. Instead, they capitalize on small fluctuations. This strategy can be profitable in both trending and ranging markets. However, it also comes with its own set of challenges. The 5-minute chart is a cornerstone of this scalping strategy. It provides a balance between detail and noise. The 5-minute time frame offers enough price action to make decisions. Yet, it's not so short that it becomes overwhelming. This chart allows scalpers to spot short-term trends and reversals. For beginners, scalping can seem daunting at first. It requires quick decision-making and precise execution. But with practice and the right approach, it can be mastered. This essay will outline a beginner-friendly scalping strategy. We'll focus on using the 5-minute chart effectively. By the end, you'll have a clear roadmap for your scalping journey. The 5-minute chart is a powerful tool for scalpers. It displays price movements in 5-minute intervals. Each candle or bar on the chart represents 5 minutes of trading activity. This time frame provides a good balance for scalping. It's short enough to capture quick moves, but long enough to filter out some noise. On a 5-minute chart, you'll see the opening, high, low, and closing prices for each 5-minute period. Green candles typically indicate bullish movement, while red candles show bearish movement. The size of the candle body represents the strength of the move. Long wicks on candles can signal potential reversals. Reading a 5-minute chart effectively takes practice. You'll need to look for patterns and trends. Support and resistance levels are crucial on this time frame. They can provide valuable entry and exit points. Volume indicators can also be helpful on a 5-minute chart. They show the intensity of buying or selling pressure. For scalping, the 5-minute chart offers several advantages. It allows you to spot short-term trends quickly. You can identify potential reversal points with more accuracy. The chart also helps in timing your entries and exits. As you become familiar with the 5-minute chart, you'll start to recognize recurring patterns. These patterns can form the basis of your scalping strategy. The trading window is a crucial aspect of this scalping strategy. We'll focus on the period from 3:30 p.m. to 10 p.m. CET, Central European Time. This time frame is chosen for specific reasons. It overlaps with high-volume trading hours in multiple markets. This overlap often leads to increased volatility and trading opportunities. During this window, several key events occur. The US stock market is in full swing. European markets are winding down. Asian markets are preparing to open. This convergence creates a unique environment for scalpers. Price movements can be more pronounced during these hours. Liquidity is typically high, which is essential for quick entries and exits. The start of our trading window, 3:30 p.m. CT, coincides with increased activity in US markets. This is often when volatility picks up. The end of our window, 10 p.m. CET, allows us to capture the early Asian market influence. By limiting our trading to this window, we focus on the most active hours. This helps in avoiding periods of lower liquidity and unpredictable price action. It's important to note that not all assets will behave the same during this window. Some may be more active at the beginning, others towards the end. Part of developing your scalping skills will involve identifying which assets work best for you during different parts of this trading window. Consistency in your trading hours can also help in recognizing patterns over time. To implement this scalping strategy effectively, your trading platform needs to be properly set up. Start by choosing a reliable platform that offers real-time data and quick execution. Popular choices include MetaTrader 4, Thinkorswim, or Interactive Brokers. Ensure your internet connection is stable to avoid any lag in data or order placement. Set your default chart to the 5-minute time frame. You'll want to have multiple charts open for different assets you're trading. Arrange these charts so you can see them all at once. This allows for quick comparison and decision-making. Consider using a multi-monitor setup if possible. It can significantly improve your ability to track multiple assets simultaneously. Next, add essential indicators to your charts. Keep it simple at first. A moving average can help identify short-term trends. The Relative Strength Index, RSI, can indicate overbought or oversold conditions. volume indicators are also crucial for confirming price movements. Customize the colors and styles of your charts for easy reading at a glance. Set up your order entry panel for quick trades. Practice placing market orders, limit orders, and stop orders. Familiarize yourself with hotkeys for faster execution. Many platforms allow you to create templates for your chart setup. This ensures consistency across different assets and trading sessions. Remember, in scalping, every second counts. A well-organized platform can give you a significant edge. Section 5, Entry Rules, when to buy and sell. The entry rules for this scalping strategy are straightforward. We'll focus on two main signals: green candles for short entries and red candles for long entries. This might seem counterintuitive at first. The logic is based on potential short-term reversals. Let's break it down further. For short entries, wait for a green candle to form on the 5-minute chart. Enter a short position at the open of the next candle. The idea is that after a price increase, there's potential for a short-term pullback. Similarly, for long entries, wait for a red candle to form. Enter a long position at the open of the next candle. This anticipates a potential bounce after a price decrease. It's crucial to combine these entry rules with other factors. Look for entries near support and resistance levels. These levels can act as turning points for price. Also, consider the overall trend on a higher time frame. Entries in the direction of the larger trend may have a higher probability of success. Volume can be another confirming factor. Higher volume on the signal candle can indicate stronger momentum. Remember, not every signal should be taken. Use these entry rules as a starting point. As you gain experience, you may add filters to improve your entry accuracy. For instance, you might only take entries if the RSI is in oversold or overbought territory. Or you might require a certain candle size before entering. The key is to start simple and refine your approach over time. Section 6, Exit Strategy, knowing when to close positions. In this scalping strategy, our primary exit rule is time-based. We hold positions until 10 PM CET, which marks the end of our trading window. This approach simplifies decision-making and prevents overthinking during the trade. It also aligns with our goal of capturing short-term price movements throughout the trading session. However, relying solely on a time-based exit isn't always optimal. It's important to have additional exit criteria. One approach is to use a trailing stop. As the price moves in your favor, you move your stop loss to lock in profits. This allows you to potentially capture larger moves while still protecting your gains. A common method is to trail your stop behind a short-term moving average. Another exit strategy involves using target levels. You can set a profit target based on recent price action. For example, you might aim for the previous swing, high or low. Or you could use a fixed ratio, like risking 1% to potentially gain 2%. Having predetermined targets can help maintain discipline and prevent emotional decision-making. It's also crucial to have a plan for cutting losses. While our main exit is at 10 PM CET, you should still use stop-loss orders. These protect you from significant adverse price movements. Place your stop-loss at a level that, if reached, would invalidate your reason for entering the trade. This might be beyond a key support or resistance level, or a certain percentage away from your entry price. Section 7, a real-world scalping scenario. Let's walk through a hypothetical scalping scenario to illustrate this strategy in action. Imagine you're watching the EUR-USD currency pair on a 5-minute chart. It's 4:15 PM CT and you've been observing the market for the past 45 minutes. You notice a series of green candles forming, indicating an upward move. At 4:20 PM, a strong green candle closes. According to our entry rules, this is a potential short entry signal. You place a short order at the open of the next candle, which executes at 4:25 PM. You set a stop loss just above the high of the green candle. For your exit, you decide to use a combination of the time-based rule and a trailing stop. The market initially moves in your favor. You adjust your trailing stop as the price descends. By 5:0 PM, you're in a profitable position. However, the market starts to consolidate. Your trailing stop keeps you in the trade as small price fluctuations occur. At 7:30 PM, a sudden spike triggers your trailing stop, closing your position for a modest profit. This scenario demonstrates several key aspects of the strategy. It shows how to apply the entry rules, use stop losses, and implement a trailing stop. It also illustrates that not all trades will last until the 10:00 p.m. cutoff. Market conditions can trigger earlier exits. The key is to stick to your predefined rules and manage your risk throughout the trade. Section 8. Risk management, protecting your capital. Risk management is crucial in scalping. The fast-paced nature of this strategy can lead to quick losses, if not managed properly. Start by determining your risk per trade. A common rule is to risk no more than 1% of your trading capital on any single trade. This limits the impact of losing streaks on your overall account. Calculate your position size based on your risk per trade and the distance to your stop loss. For example, if you're risking $100 on a trade with a 10 pip stop loss, your position size would be 1 mini lot in Forex trading. Use a position size calculator to make this process easier and more accurate. Never increase your position size to compensate for losses. Implement a daily stop loss as well. This is the maximum amount you're willing to lose in a day. Once you hit this limit, stop trading for the day. This prevents emotional decisions and protects your account from significant drawdowns. A daily stop loss of 3 to 5% of your account is common among professional scalpers. Keep track of your win rate and risk-reward ratio. In scalping, a high win rate is often necessary to overcome transaction costs. Aim for a win rate above 50%. Your average winning trade should be at least as large as your average losing trade. If these metrics aren't in your favor, review and adjust your strategy. Remember, consistent small profits are the goal in scalping. Section 9. Market conditions and transaction costs. Understanding market conditions is vital for successful scalping. Not all market environments are suitable for this strategy. Ideal conditions include high liquidity and moderate to high volatility. These factors allow for quick entries and exits with minimal slippage. Be cautious during major news releases. The increased volatility can lead to wider spreads and unpredictable price movements. Pay attention to overall market trends. While we're trading on a 5-minute chart, it's helpful to be aware of larger time frame trends. Trading in the direction of the overall trend can increase your probability of success. Use a higher time frame chart like the 1 hour or 4 hour to identify the broader trend. This can help you filter your trades and avoid counter-trend scalps. Transaction costs are a significant factor in scalping. These include spreads, commissions, and any other fees charged by your broker. Because scalping involves frequent trades, these costs can quickly eat into your profits. Choose a broker with competitive spreads and low commissions. Consider using ECN or electronic communication network accounts, which often offer tighter spreads. Calculate your break-even point for each trade, accounting for all costs. This is the price movement needed just to cover your transaction costs. For example, if your total cost per trade is 2 pips, you need the price to move at least 2 pips in your favor to break even. Understanding this helps in setting realistic profit targets and managing expectations. Always factor in these costs when backtesting or evaluating your strategy's performance. Section 10. Mental preparation and backtesting. Mental preparation is crucial for scalping success. This strategy requires intense focus for extended periods. Develop a pre-trading routine to get in the right mindset. This might include reviewing market news, checking economic calendars, or doing some light exercise. Stay hydrated and take regular short breaks to maintain concentration throughout your trading session. Emotional control is paramount in scalping. The rapid-fire nature of trades can lead to impulsive decisions. Stick to your predefined rules even when facing a losing streak. Avoid the temptation to chase losses or overtrade. Keep a trading journal to track your emotional state along with your trades. This can help identify patterns in your decision-making and areas for improvement. Backtesting is an essential step before live trading. Use historical data to test your strategy. Many trading platforms offer backtesting features. Go through past market data, applying your entry and exit rules. Record the results meticulously. Look for patterns in winning and losing trades. This process helps validate your strategy and build confidence in your approach. Start with paper trading or a demo account before risking real capital. This allows you to practice the strategy in real time without financial risk. Treat paper trading as seriously as you would real trading. Follow your rules strictly and record all your trades. Once you've achieved consistent results in paper trading, gradually transition to a small live account. Remember, proficiency in scalping takes time and practice. Stay patient and focused on continuous improvement.